G'day everyone, welcome to the weekend update for the 5th of May, and we saw a very significant breakout in the US on Friday night. Set an all-time high above 1600 on the S&P and above 16,000 for the first time in history on the Dow Jones. So it certainly looks like the short-term correction that I was expecting to have, and certainly some of the signs were pointing to, has just been swamped out again, and that was partly due to the actions of the ECB lowering interest rates in Europe through the week, but also some better jobs reports and also some pretty solid corporate earnings in the US. So yes, there's certainly some poorer signals that a lot of people are still very anxious about, but there are still plenty of positive signals, and that's really what the market is focusing on at the moment. So let's jump in and have a look at a summary of what happened last week. The S&P on the week ended up a very healthy 32 points higher, and as I said, you can only conclude that the short-term correction is over because we've now formed a new all-time high. By comparison, our market was pretty disappointing, but I guess we'll see some catch-up on Monday morning. We were higher by 32 points on the week. And really, it's still just the banks and the telcos are still the leaders. The resource stocks really still lagging very badly. Now, one of the reasons that 2013 is shaping up as a really good year, and I've been saying this since the latter half of last year, is that European bond yields have been tracking down and still are. And what that means is that the major players who are buying bonds in Europe are prepared to take a much lower risk premium than they were 1 or 2 years ago. And so that's just a sign that no one's fearful anymore that things are really going to come unstuck in Europe. And you might be still reading and hearing about all the nasty things that can happen in Europe and how it's in recession and all this doom and gloom, but you've just got to look at what the major players are doing. We've now got the Italian 10-year bond yield under 4%. Wasn't that long ago it was over 6%. And we've now got the Spanish yield, which was above 7, is now down to 4. That tells you all that you need to know about the real situation in Europe. It's not that bad. And we've got the German stock index basically at all-time highs. So look, yes, there are some problems, but a lot of it has already been factored into the market. Now, the US dollar was steady on the week, and we've got a continuation of the currency wars. The US dollar would be lower, except for the fact that with the ECB cutting interest rates, the euro fell again, which tended to push the US dollar up. But we've still got this race to the bottom between all the major currencies. They all want to keep their currencies relatively weak, and that means lots more money printing, and long term that's got to be a significant positive for gold. Speaking of which, gold rose by $6 on the week, so only a very slight gain. And to be feeling more comfortable that we've seen a bottom in the price of gold, and we'll have a look at this on the chart in a minute, I'd really want to see gold close above 1470. Now it's about $5 or $6 short of that at the moment. So I think if it can get back up beyond that 50% retracement level, I'll be feeling a lot more comfortable that we've seen the bottom in gold. But of course we do have another indicator as well, which I'll take a look at in just a minute. Now copper, which had got down to almost $3, has kicked back up to $3.29, quite a big surge on Friday night. And we saw oil rose also from around $86 only a week or two ago, now back up to $96. And there's the 6-month spot chart on copper. You can see it really fell away sharply during the latter half of April, but certainly recovered quite nicely in the last 2 sessions. So let's jump over and have a look at a few charts. We'll start with the S&P index first of all, and you can see 2 really strong sessions on Thursday and Friday to complete the week, and really this has been a very mild pullback, and it really just consistent with everything that we've seen since basically November. So every time the market has pulled back, it's only lasted about 5 or 6 days, and it's only gone down by maybe 30-40 points in total. So again, the same sort of pattern. So this is now new all-time highs, closed above 1600 for the first time in history. So if we pan back and take a look, we've now got, obviously, we formed a higher high in 2007 than we did in 2000, and now we've gone on and formed a higher high here. Now this rising wedge that I've been pointing to appears now to be broken to the upside. And the other thing to notice on this chart also, the red line, which is the 150-day moving average. Now if we go right back to here, this is March 2009. This was the bottom of the crash, and whilst we had an initial strong surge in the S&P, the value of the index then basically fluctuated above and below that 150-day moving average, and that was because of the significant corrections we got. First of all, very sharp correction in August of 2011, then again in May of 2012 and in November of 2012. But that then formed the low. So here we are at the low on the 16th of November 2012, and since then you can see that the index has stayed robustly above that 150-day moving average, above that red line, and now is probably as far above it as we've seen at any point in time. So there is still very, very significant momentum in the US market. Now the other indicator I've been looking at over the last couple of weeks as a bit of a sign that maybe the US market was running out of market breadth, and that could have been a precursor to a more significant fall. This is the Russell 2000 index, and as you can see, we had these lower highs and lower lows. So we did appear to be getting a divergence here between the small cap index and the major indices, which is very often a leading indicator of the market turning over. Now that hasn't followed through, and you can see we had quite a big jump on Friday night, and basically new short-term highs there. Let's have a look at the Nasdaq, another bit of a canary in the coal mine short-term indicator, and the Nasdaq just continues to power on. So I think you can say again that the US market is again in uptrend. Certainly the rubber band is getting stretched, but I'd have to say that a lot of the corporate earnings are coming through, and they're not too bad. And you've got to remember that you can't look at stock market values in isolation. You've got to look at them relative to the other avenues for people making money. And with interest rates and bond rates so low, then people are prepared to go more into risk assets now in the stock market, and therefore there's no reason why the prices can't keep rising. Now let's turn to the Australian market, because there's a very stark comparison here with the other international indices. If we pan right back and have a big picture look, there's our high in 2007 up at 6,800 points. So unlike the US market, which is basically at all-time highs, we're a long way under that, and that really is all about the resource stocks, because our banks have recovered fairly well and are back to their all-time highs. So that is just how much the resource sector has been a drag on our market. Now I just want to have a look at just on a sector by sector basis, and this is the main Australian sectors, and we've been looking at this for a while now, but and there's really been no change. But if anything, the sectors are even the gap between them is getting even bigger. So at the top we've got healthcare, clearly the best outperformer by a long way. Underneath that we've got basically the teleco sector, which is obviously Telstra. Slightly behind is the banks, but they've been tracking each other pretty closely now since around about May of last year. So about a year, telecoms and banks have pretty much done the same thing. And then we've got a huge gap down to energy, small caps, and of course BHP and Rio pulling up the rear, and they've actually been falling in recent times on a relative comparison basis. So huge divergence in the Australian market. Now that will turn around at some point. All cycles reach extremes, and it's my opinion that the Australian banks and telecommunications sector is beyond fully priced, and probably some of our resource stocks are probably undervalued. So there will be a turnaround, there will be a swap over, and money flows will go the other way, but we're not there yet, so you don't want to go punting on that one just yet. Now let's have a look at gold. So the price of gold did track higher on Friday night. It got up above 1480. So this is the retracement that I'm looking at from the bottom, which was the 16th of April, going back to the short-term high, which was the 21st of March. So if we can get above 50% on a closing basis, then I think that's a pretty good sign. If we can get above 1503 on a closing basis, then that's an even better sign. So we're just flirting with it now. Closed the week at 1465. So just a little bit, another $10. If we can close next week $10 higher, that would be positive. But above 1505 would be pretty much seal the deal, I think, in terms of the bottom being in gold. But a more important indicator is the spread between the GDX. In fact, let's look at the GDX first. So this is the Gold Miners Index. This is probably the most watched index overseas, and as you can see, there are some indications that it's bottoming out, but then it did it also up here again in March. It leveled out, looked like it may turn higher, and then had another big leg down with the crash in gold. So this is by no means definitive. But what is a more reliable thing to look at is this spread, which is the GDX index divided by the price of gold. And as we've looked at this quite a few times, look at this one every week because it's really a key indicator to watch. This is 2008, the bottom in 2008, and you can see when the line rises, then gold stocks are outperforming gold and will also tend to lead the bottom in gold. The bottom in stocks in 2008 occurred about 3 weeks before the bottom in gold. When it's tracking sideways, as it did for 2 years, they're both performing about the same, and during that period they both rose, but at the same rate. But since the end of 2010, gold stocks have done far worse than gold. So they've fallen faster. And you can see that really has been quite extreme in recent times. Now the bottom for gold, or certainly the bottom for gold stocks, will occur when this line turns up, crosses this moving average, and we're likely to see a bottom in gold shortly after that. So that's the main indicator to be looking at. So that's it for this week. It should be certainly a very positive opening in the Australian market on Monday. And the signs are that the huge disruptions that we've seen through April, May, June and July of the last 3 years is probably going to be either non-existent or significantly less than what we've seen previously. And that's what I've been saying all along, that 2013 and also probably into 2014 really did look like a much better period for making money. So let's just finally have a look at, just from a big picture strategic approach. I'm now signalling going back to overall exposure levels could be raised again, but certainly stay with the current momentum, which is not in resource stocks. Don't try and pick the bottom. It's too tough, too dangerous. Stay with the existing momentum that's there. Gold stocks, excuse me, still not outperforming. So I would much rather pay 10% more waiting to see the gold stocks start to really turn up than taking the risk of being too early. So that's it for this week. Cheers.